Hello everyone, welcome back. We are now in Chapter 4, Strategizing Performance Management. As we discussed in our previous chapters, there are three key domains or the sites in which strategies are enabled and enacted with different but interrelated strategic imperatives. Market for strategic positioning, then organizational hierarchy with performance management, management control, and organizational resilience. Then finally, point of production related to the strategic imperatives of quality, flexibility, and cost. We are now in this chapter moving to the organizational hierarchy and deal with the first strategic imperative of managing performance or the strategic performance management. And strategic performance management or this particular topic is divided into two key themes. First one is the traditional responsibility accounting based performance management. We will discuss the traditional mode of performance management, their key features, and then its fundamental weaknesses. And then second theme is strategic performance management. So under that theme, we will discuss how the weaknesses of the traditional responsibility accounting based performance management is addressed through new strategic performance management framework such as balanced scorecard. So here we are in the video 1, which talks about the traditional responsibility based performance management systems. Now this responsibility accounting systems are grounded or are created on the basis of two fundamental principles. The first principle is that the organization should be divided into and arranged as a series of responsibility centers which can be hierarchically arranged. Therefore, in terms of responsibility accounting, organization should be a hierarchically arranged series or a set of or collection of responsibility centers. That's the first principle. To organize, to configure the organization into a set of responsibility centers which can then be arranged hierarchically. And second principle is called principle of controllability. Principle of controllability basically means any manager should be held accountable only for those actions, processes, and outcomes which that manager can control. If something is beyond that manager's control, we cannot hold that manager accountable for those events, incidents, processes, actions, or outcomes. So those are the two fundamental principles. The configuration of the organization into a totality of responsibility centers which can ultimately arrange into a hierarchy. Second one, principle of controllability. Then, in responsibility accounting, we divide the organization into four different kind of or form of responsibility centers which can be hierarchically arranged. At the very bottom, we have cost centers. Cost centers are those centers of which the performance is measured or managed on the basis of cost criteria. So the ultimate objective of a cost center is to manage the cost. So therefore, a cost center manager is accountable to manage the cost of that particular center. That's at the very bottom. And second level or second form of cost responsibility centers are called revenue centers. So in a revenue center, the responsibility manager or responsibility center manager is accountable for revenue targets. Then combining these cost centers and the revenue, or the, for example, sales targets or centers, we have profit centers. The cost centers, revenue centers combined at a higher level, and higher level manager is responsible for profit. So these are called profit centers. And then combining related profit centers together, we will have a division or a business which we call an investment centers. So the investment center managers are accountable for achieving a target level of return on investment. So that's a cost centers of which the managers are responsible to achieve a target level of cost. And then there are revenue centers of which the managers are accountable to achieve a target level of revenue. And then there are profit centers of which the managers are accountable to achieve a target profit. And then finally at the highest level, we have investment centers of which managers are accountable to achieve a target return on investment. So that is the hierarchy of responsibility centers. Now, when we are going to manage these responsibility centers, so performance of these responsibility centers, the performance has to be identified in a specific manner. So in understanding what we mean by performance here, or defining performance here, we have to first differentiate between performance and doing. Doing basically means carrying out various activities. For example, inside an organization, we produce goods, produce services, we carry out various decision making, coordinate things, plan things, and many other activities are carried out in the organization. Now outside the organization, for example, for simplicity, we do various things such as dancing, singing, writing, cooking, walking, running, and so on. And similarly inside the organization, producing, meeting, talking, discussions, presentations, and so on, we do many things. And those doing will become performance. When those doings, that means those actions, processes, activities, and the outcomes are subject to observations, monitoring, assessment, evaluation, judgment, and subsequently punishment and rewards. Then they become performance. So the performance are those activities, actions, processes, behaviors, and the outcomes which are subjected to observations, monitoring, evaluations, assessment, judgment, and finally rewards and punishments. So that's how we define performance in a very broad sense. So to do that, that is to convert our actions and outcomes into performance, we need 4 key elements of performance management. So in other words, performance management constitute 4 fundamental elements. The first one is expectations or desires. We have to have some expectations and desires for our actions, activities, processes, behaviors, and their outcomes. So these expectations or desires can be spelled out in terms of, for example, targets, objectives, goals, indicators, rules, procedures, protocols, standards, and so on. So those kind of manifestations ultimately manifest our expectations and desires related to various activities, actions, processes, procedures, and behaviors, as well as their outcomes. So that's the first element, expectations and desires. The second element of performance management is, this is equally applicable for control, is a system of knowing, system of assessing, system of understanding the actual conditions. So we will have an expectation for a certain activity or a process or outcome or input. And then we have to have a system through which we can actually assess what is the actual condition, reality of that thing that we are going to manage. So this is where the accounting calculations come into being. Okay? So we actually calculate what's our actual level of production, actual level of cost, actual level of sales, and actual level of investment, and so on. Okay? And actual level of return and risk, and so on. Okay? So those are the calculations. So the desire and the actual. Then there should be a method of comparing between the desire and the actual, and identifying whether there is a significant deviation or variance into which the managerial attention should be paid. So the actual, expectation, and the deviation, which may need managerial actions. Then the fourth element is the power, capacity to intervene, power and capacity to make decisions and to take actions. So those are the four key elements of performance management. So ultimately, a well-managed performance basically means bringing these desires overlapping with the actual. If you can bring the domain of desire to overlap with the domain of actual, then it is well-managed performance. So if there's a gap between the actual and the desires or the expectations, then the performance are not well managed. So the performance management challenge is to bring these expectation and the actual to overlap each other. So that's the basic logic of performance management. Then in organizational settings, in a responsibility accounting settings, we have a specific set of accounting tools to do that. Specifically, two accounting frameworks or set of tools. The first one is called budgets. Very popular. For centuries we have been using budgets, and currently using, and even in the future we will be using budgets in different forms. So there will be operational budgets as well as master budgets. So as you should have studied in your previous management accounting courses, there are operational budgets such as, for example, material usage budget, labor usage budget, material purchase budget, labor recruitment or hiring budgets, overhead expenditure budgets, sales budget, and so on. So those are operational budgets. Then we combine them together to create master budgets such as budgeted profit and loss account or income statement, budgeted cash flow statement, as well as budgeted balance sheet or budgeted statement of financial position. So those are the master budgets, and ultimately related to return on investment. So that's one set of accounting tools that we are using in responsibility accounting systems. So another set of accounting tool is what we call standard costing or variance analysis. So together with budgets, we have standard costing or variance analysis. So we set various cost standards, revenue standards, profit standards, and so on. And then we compare our actual results with the standard and identify the deviations or the variances, and then take the relevant, appropriate decisions and actions. So that's the two set of accounting techniques that we are using in responsibility accounting: budgets and standard costing or variance analysis. And then when we are using these standard costing and variance analysis, as I already said earlier, okay, so we attribute specific responsibilities to managers, and their performance are managed on that particular basis. So far we discussed the principles, fundamental doctrines upon which the responsibility accounting system is constructed. The principle of hierarchical configuration of the organization into responsibility centers, and the principle of controllability. And then 4 types of responsibility centers: cost centers, revenue centers, profit centers, and investment centers. And then budgets and the standard costing as the fundamental accounting technologies of managing performance. And then there are weaknesses. This traditional responsibility-based accounting is critiqued in many ways. For example, when you read your previous years or previous management accounting courses, you would have studied that these budgetary systems are very weak, or they have limitations related to budgetary slacking, for example. And similarly, empire building, overestimation of cost, and so on. Okay. So those are the commonly attributed weaknesses. But however, when it comes to thinking about strategic limitations of these traditional system of performance management, or in other words, the strategic weaknesses of responsibility accounting systems, there are 2 fundamental limitations. So among many other limitations, these are the most fundamental strategic limitations. The first one is called the problem of balance. Second one is the problem of linking. The problem of balancing basically means the responsibility accounting systems only captures the financial dimension of performance. It does not capture non-financial but strategically critical other dimensions. So the responsibility accounting only captures cost, revenues, profit, and investment, nothing else. So therefore it is only lopsided. It's only singularly thinking about financial performance, not non-financial performance. So that is the problem of balancing. So which is one problem that balance scorecard and other strategic performance management systems try to address. And then second problem is linking. Linking means the lack of connection between the operational or the actual performance and the strategic long-term objectives and the strategies of the firm. So there is no connection between these performance criteria or performance management system with the corporate strategies. So this is called problem of linking. So problem of balance and the problem of linking. So the strategic management accounting system. So in other words, strategic performance management systems are introduced to overcome these 2 fundamental problems. So we will discuss that in our next discussion with Kaplan and Norton's balanced scorecard. So until that, thank you very much for watching this. See you again in that discussion.